So I'm going to start on overview of investment banking. Essentially, we're going to do, I'm going to do two sections with you. Investment banking in terms of overview, what we mean by investment banking and what it is and what are the products and services offered and so on, as well as next session, we're going to look at asset management and what happens in asset management. Again, what are the products offered and how it's done and so on. So these are the two areas. Broadly, both fall under the broad category of investment banking. But we are going to concentrate on pure investment banking today. This might be a new area for some of you. Investment banking is not very very well known across commercial banks, but certainly it's an integrated concept where there is a lot of work that can be done together. Any of you any idea when you talk about investment banks, what is an investment bank? What do investment banks do? Any idea? Sorry, go ahead.
Monthly investments for their savings or product or any investment product.
Okay, so making investments, kind of, that's what you're saying, right? Anything else? Anybody else? Any other ideas?
It's investing for other companies.
Investing for other companies, okay. Similar line of thought. Anybody else?
Investing treasury bonds.
Investing in treasury bonds, okay. So everybody's coming up with a similar range of thoughts, right? So most of the thoughts that we've had is investment banking essentially is about investing. That's where we've seen, like, a lot of you are pitching. Most of the answers that are coming out is about investing. So investing in treasury bills or investing for other companies or clients or for the bank, right? It's about investing. Actually, investment banking has nothing to do with investing, right? Nothing to do in the traditional sense of investing. So that's a common misconception. When you hear the name, obviously you think, when you think about investment banking, you think about investing, right? But really, investment banking is the concept is a little different. Does anybody want to say something? I can hear somebody. Okay. So essentially, an investment bank is a financial services company. It engages in different types of services. Most of these are advisory services, advisory-based transactions on behalf of individuals, companies, governments. Okay, what do you mean by that? Investment banks are essentially intermediaries that help people who want money find money in different ways. So obviously, yes, if you want money in the sense you are looking to borrow, or you're looking to raise money in a different way, then obviously you can go to a bank. And that's what most of your lectures throughout this series is based on. Banking is based about, what you can do in the bank to offer different types of services. This investment banking is somewhat different, right? It doesn't just, banking is, banks are just one set of its investment clients. So what happens is, when you have companies who are looking to raise capital, right, raise funds, maybe in the form of shares, maybe in the form of loans, investment banks help these companies raise money by finding people to invest with these companies, maybe again in the form of shares or in the form of loans. So it doesn't need to be banks. So it's another alternative avenue other than banks for a company to raise money from. So it's not that the investment bank lends money to these corporations. Investment bank simply acts as an intermediary between people who have money and companies or governments who need money, who want money for some purpose or the other. They act as intermediaries and they help these people, these governments or companies who need money, find alternative ways of raising money. And they find investors to do that. Any questions? Any clarification? So you have to understand, investment bank is simply a go-between, right? It's simply a go-between between investors and companies. Companies want to raise money, and raising money is not necessarily only taking loans. They might be wanting to take loans. They might be wanting to, take loans in the form of debentures or commercial paper or securitized paper, or they might be wanting to raise money through shares. Go to the public, go to the market and raise money through shares. So whichever form that they're looking to raise money, investment bankers will help these companies raise money because they have they have a huge base of investors that they can tap into and help these investors come and invest in these companies. Okay. So investment banks essentially, like I said before, is a financial services intermediary. It is a go-between. It is not a bank that makes investments. And sometimes when you see a little later, investment banks are not necessarily private companies are known as investment banks as well. So it's not that it's a bank at all. What are the defining features of investment banks? They don't take deposits. Unlike a traditional banks take deposits, right? What do traditional banks do? What do you all do in your daily, most of you all, as I understand it, are in the banking industry, or pretty much all of you are in the banking industry. How do you make money in the banking industry? How do banks make money?
By lending.
By lending. So they'll take money through deposits and they'll give out loans and make money through giving out loans, right? Investment banks, excuse me, investment banks don't take deposits. Okay. They help corporates raise money through debt or through equity, and they provide strategic advisory services. So they're simply an advisory services company. So what are the most prominent activities investment banks do? They act as advisors for companies who are doing mergers and acquisitions, right? You might have heard, if a company is to be taken over, or if a company is looking to merge with another company or be acquired by another company or spin off a department, right? What do investment banks do? Typically, they would be the advisors to these companies. They would help these companies do that process, right? Do like a lot of work in terms of working with the company. What is the right valuation? At what price should you buy the other company? Or at what price should you sell your company to the other company? They are the advisors through all of these processes. Versus also another big thing that investment banks do is act as what we call underwriters. And underwriting here does not necessarily mean the same thing as what we talk about when we talk about traditional banking. All right. Underwriting here simply means that you help companies by giving your own money in this sense, raise capital by selling stocks or bonds to investors. Now, investment banking, these are the two traditional activities that investment banks do. The two big things that investment banks do, right? But you can have pure play investment banks and you can have full service investment banks. full service investment bank. Meaning you can provide all different types of services. So pure play investment banks, usually these are the types of services that they offer. Some, if I put it into different activities or break it down a little bit more, you can help clients raise money through doing IPOs. IPOs mean initial public offering. They can help clients raise money through IPOs, buy commercial paper, buy a securitized paper, syndicated loans, right? I'll be talking about most of these a little bit more in detail as we go along. They can provide advisory services for M&As, mergers and acquisitions, or spin-offs of companies, provide business valuation or restructuring advisory, things like this. These are the different types of services a pure play investment bank would offer. But in addition to these types of services, investment banks can also have departments or divisions or subsidiary companies which have asset management, broking houses, stockbroking companies. Well, these are the main two. Research arms. If investment banks also hold stockbroking, research, asset management, we call these full service investment banks. You have pure play investment banks, purely doing only investment banking activities. What are only investment banking activities? Helping investors who need money, or sorry, companies who need money, raise money by facilitating or helping investors invest in them, right? But other than those pure play investment banks, you can also asset management, stockbroking, research, all of these other activities also fall under the broad categorization of investment banking. So where you have companies that are, encompassing all of these different activities, we call them full service investment banks. Any questions or clarifications? Okay, so investment banking, I broadly divide it into two components, right? You can have different definitions or different categorizations. We can broadly define investment banking in this categorization, one called fee-based versus fund-based investment banking. Mainly, investment banking provides fee-based services, meaning they are entities that provide advisory services for a fee. They are entities who help companies raise money, but they don't give the money, unlike a bank. Banks give loans, right? Banks provide money to corporates. Investment banks don't do that. Investment banks essentially help or advise companies how to find money and help companies find money by finding investors to invest in the company. For this, they charge a fee. So these are called fee-based services. Few investment banks, especially in Sri Lanka, very few investment banks. Abroad, you have much more investment banks, especially in the US, you would have fund-based investment banks as well, where the investment bank itself has funds, right? Not necessarily through deposits, but they would raise money through issuing maybe stocks or bonds, and they would use these funds to go and invest in these companies. So these are called fund-based investment banks. So the way investment banks make money, this categorization is based on how do investment banks earn. In general, in Sri Lanka, they earn fees. They are simply advisory service providers who earn fees on the advisory services that they provide. Versus, we don't have a lot of fund-based investment banks in Sri Lanka, but abroad, you have a lot of fund-based investment banks. These investment banks, in addition to doing fee-based activities, will also do fund-based activities, meaning they will have a fund of their own. They will have money of their own to go and invest in these companies who are looking to raise capital. So, what are some fee-based services? that investment banks. For example, M&A, mergers and acquisitions. In M&A, what do investment banks do? They are not going to go and acquire a company or merge with a company, right? They're going to help two companies merge with each other, or help a company acquire another company, or vice versa. And they will charge a fee for helping facilitate that process. They will help companies raise money from the debt markets or equity markets via an IPO, for example, an initial public offering. And they charge a fee for it. They will do debt structuring. Debt structuring meaning, if you all have heard of securitizations, I will explain some of these if you have not heard of it as we go along. If you all have heard of securitizations, these are ways that what you are doing is essentially structuring your cash flows in such a way and giving alternative ways of raising money through loans. So debt structuring, these are all fee-based services because they will structure the loan, structure the debt instrument, offer it to investors, and investors will invest in the debt instrument of a certain company. And these is essentially, these are all fee-based services that investment banks do. And what I have highlighted here in different color, asset management, equity research, sales and trading, or brokerage, these are other services that are also fee-based that investment banks provide. But these, will fall under the full service investment bank proposition. So these three are fee-based activities that fall under pure play investment banking proposition, versus these three fall under the full service investment banking proposition. Asset management. How is asset management a fee-based service? What do you think? How do you think asset management falls under fee-based service?
Excuse me, madam. Slide is not moving.
Slide is not moving?
Yeah,
oh,
yeah.
No. What do you see now? What do investment banks do?
In the first topic.
No.
Still in topic here. Now it's okay.
Did you see this slide?
Okay, now see investment banks.
Right. You all didn't see this slide beforehand, is it?
No, no.
Oh, no. Okay. So this is where I was explaining investment bank is a financial services company, right? And this is where investment banks fall in the middle of companies who want to raise money and institutions who have, or investors who have money. So they will be the facilitators or agents who act as that go-between to help these companies raise money by debt or through equity. And then this is the slide I explained about commercial banks and investment banks, the difference, where commercial banks are essentially in the business of taking deposits and giving loans, and they keep a margin, right? So they make money by keeping a margin. Commercial banks are fund-based entities. They have funds. How do they have funds? They take deposits and they give loans using those deposits. And they make a profit through that margin that they keep between the loan rate and the deposit rate. Investment banks don't take deposits, right? And especially what I was talking about, these fee-based investment banks, they only do fee-based services and they charge a commission for those services. So the only thing they do is they help corporates raise money through debt or equity and provide strategic advisory services. These are different things that they do. Okay. So this is where I was telling you, investment banks, typically you have two areas, advisory services in M&A as well as underwriting, where underwriting is not the typical definition of underwriting that you might know, but underwriting is about raising capital by selling stocks or bonds to investors. And you have pure play investment banks versus full service investment banks, where in full service investment banks, you provide brokerage services, asset management services, research services, and so on.
Excuse me, madam. That means commercial bank can't involve with that investment banking activities.
Commercial banks do have investment banking activities. So, for example, I'll show you later some of the investment banks in Sri Lanka. There are commercial banks that have investment banks as subsidiaries, or commercial banks that have divisions where they have investment banking divisions. So they do get involved in investment banking activities as a separate division or a separate subsidiary. But you can have investment banks that are not commercial banks at all. Standalone companies, they're still known as investment banks.
Okay, thanks.
Madam, actually, do they need to get a special license from central bank to do investment banking, like license specialized and license commercial banks?
So no, investment banking falls under the purview of the SEC. Earlier, they weren't really under the purview of anybody. But with the new SEC Act and everything coming into play, investment banks fall under the purview of the Securities Exchange Commission, not the central bank.
Okay, thank you.
So that is because investment banks generally in Sri Lanka are not fund-based. They don't take deposits. They don't use other people's money to lend money. They are mainly fee-based. They simply act as an agent to help people meet each other, people meaning companies who have money, facilitate that process where they can invest in companies that need money. I think that somebody needs to mute because I'm echoing. Thanks. So, because they are fee-based, central bank doesn't need to. Most of these companies are fee-based, and so even if they're fund-based, they're not taking deposits. So so central bank doesn't need to be involved. It's the Securities Exchange Commission that is involved in this process. So this is where I was telling you these three, right? In a slightly different color, you can see are examples of fee-based services, like, for example, mergers and acquisitions, because investment banks provide advisory services and charge a fee for that advice. They help companies carry out equity IPOs or debt IPOs and charge a fee for that. Debt restructuring or debt structuring, where they try to structure the loans in a different way and find alternative investors to come and invest in those loans. And I'll talk about some of these methods later on. And they charge a fee because they are not investing, right? The investment bank is not investing in any of these. They are simply arranging the transaction. They are arrangers, and they charge a fee for arranging the transaction, an advisory fee. And then these three that I've highlighted in slightly different color, asset management, equity research, and sales trading, which fall under the purview of that full service investment banking. These three are also fee-based services. And this is where I was asking, how does asset management become a fee-based service? Go ahead.
So that means asset management means that according to the company having some their borrows from any banks, no? So that means investment banking can do that, manage their assets and
so not necessarily the company, but the company meaning not necessarily the bank, but yes, asset management is where you manage investments, like what you all were talking about, investing in different places and investing in stocks or bonds or whatever, and managing a portfolio for somebody else. That's asset management. But when you manage the portfolio for somebody else, you're not managing your own money. Because you're not managing your own money, you charge a fee for managing that portfolio on behalf of somebody else, right? Just like that, a broker, what does a broker do? A stockbroker. They help buyers and sellers meet, and they charge a fee for that service. So these are why we say, even in under full service investment banking, most of these services are fee-based services. Versus Few investment banks are fund-based. Fund-based means they might themselves have issued a debenture or some sort of bond, raised money, and they have now money of their own. And they can use the money of their own to invest in these companies who are looking to raise money through IPOs or debentures or whatever. Right? So they do this through the process of what we call underwriting, where underwriting essentially means you are buying shares of a company when it doesn't get subscribed in an IPO, and proprietary trading. Proprietary means your own. Proprietary means your own. So proprietary trading means you're managing your own funds. So you're trading your own money in stocks and bonds or whatever and trying to make a profit out of your own portfolio by investing your own portfolio in shares or debentures or bonds or whatever. Questions? Okay. So these are the different types of investment banking activity I was describing, and we'll go through each of these different types of activities in a little bit of detail. So I'm going to concentrate a little bit more on these IPOs, but I'm going to go through in detail about the different types of activities that investment banks engage in. So first, let's talk about helping clients raise money. Helping clients raise money through commercial paper, IPOs, securitized paper, or syndicated loans. What's a commercial paper? What are commercial paper? Any idea? Have you heard of commercial paper? Have you heard of debentures?
Debentures, we
So what are debentures?
debentures mean normally if somebody wants some capital, so we can get the money from that people and invest for that debenture. So that means raise the capital. No?
Right. So what? Okay. So debentures essentially is a way for a company to take a loan, and so is commercial paper. So is securitized paper. Right. There are two ways companies can raise money instead of going to banks. Right. They can come to the capital markets. What do you mean by capital markets? Capital markets means you come to all investors and ask for money. Right? So you and I can also give companies money when they want to borrow money or when they want to, when they ask us to invest. We are part of the investment base of capital markets. Investment bankers are the agents of capital markets helping these companies raise money through capital markets. Okay. So banks will also be one type of investor in capital markets. What do I mean by capital markets? The stock market is a capital market. The bond market is a capital market, right? These are all different types of markets that are there. So, for example, there are different ways of raising money for a company, right? Now, when you talk about a company trying to raise money, a company who needs money, they can either directly go to a bank and borrow money, or they can come to the market and borrow money from you and me. Financial markets. When you and I invest in shares, what are we doing? We are essentially giving companies money to raise. We're essentially giving companies money. When they want to raise capital, we're giving them money, right? So what are financial markets? You have the stock market, you have the bond market, you have the money market. All of these are components of the financial market or capital markets, in other words, right? And banks can invest in these financial markets. I mean, you have banks that buy shares or buy bonds, right? Banks obviously buy bonds or treasury bills or whatever. So they come and invest in the financial markets as well. But for companies who want to raise money, they can either go to a bank and ask for a loan. We call this indirect financing. Right. It's not direct financing actually. Going to a bank and asking for a loan is what we call indirect financing. And going to the financial markets and asking for money is called direct financing. It seems counterintuitive, right? You would think you go to a bank straight away, ask for a loan. But understand how do these markets or banks or whatever get money? They get it from you and I, the common people, right? We go and invest in banks as deposits. We give money in the form of deposits. Banks will take these deposits and give loans to these companies who want loans. That's why we call bank loans indirect forms of financing, because banks act as an intermediary. They act as an intermediary where they take deposits from the general population and then on-lend those as loans. Otherwise, the company can come to the financial markets and ask for money in the financial markets in the form of debentures, in the form of shares, commercial paper, securitized paper, right? What is happening there? A market is simply like a polar, right? It's where you go, your polar is what? You go shopping for your vegetables and fruits in the polar. Like that, what's a financial market? It's where you go shopping to invest in different companies, right? So when I go shopping to invest in different companies, I am directly participating in the financial market. And this company, when they want money, they come and say, I have this share. I want to raise money. So, for example, you would have seen, if you all are interested in capital markets, you would have seen on Friday, Expec was the latest company to come to the capital markets and ask for money, right? Expec corrugated cartons, that company, they came and they did a equity IPO. What do you mean by that? They came to the market, asked investors to invest in their company and become shareholders of their company. So investors, if they applied to invest in that company, what are they doing? They are directly giving their money to the company, which is why when we transact through markets, we call it direct financing. Okay. Investment banks are agents. They are like brokers, they are agents. They are agents that will help facilitate these transactions, help these companies find these investors, help these companies list their products in the market. There are agents that help them do that. So the first one that we're going to talk about, how a company can raise money through this direct financing method, is commercial paper. Commercial paper essentially means short-term financing. When a company is looking to raise money short-term, right, short-term, for their working capital purposes, to pay their salaries, their payables, buy inventory, this like short-term, when they want to do something, they can come to a bank, ask for overdraft or something like that, or a working capital loan, or they can go to the markets, not to the stock market, but you can go to an informal market where you essentially say, I'm looking to raise some money. I would like to take a loan from you and me. Okay. So they offer a piece of paper that essentially is a certificate that says, I, the company, promise to pay you back this amount after this number of days. at this rate. And that piece of paper is called a commercial paper. Right? It's simply an unsecured short-term debt, a short-term promissory note that's issued by a company. A commercial paper format looks something like this. As you can see, this I've blanked out all the places where information is available, right? But you can see here, there is a company that is trying to borrow a certain amount of money. So you and I, we can go and lend this company money. Usually for commercial paper, some companies allow individual investors to invest. Some companies don't like it when individual investors invest. They would prefer other companies or larger high net worth clients maybe sometimes to invest, because commercial paper do have minimum thresholds, right? So for example, if you're investing in a commercial paper, sometimes companies can say the minimum amount invested should be 5 million rupees or 10 million rupees. So, you and I, everybody won't have 5 million rupees or 10 million rupees to invest in a commercial paper, right? But this piece of paper, if it has the name commercial paper, is a debt instrument that is less than 1 year. The maximum tenor of a commercial paper by definition is less than 1 year, right? So when companies want to borrow short term, whether they want to borrow for 1 month or for 2 months, 3 months, or 12 months, they will issue commercial paper, and they will ask the investment bank. They will call up the investment bank and they'll say, I need to raise 500 million for my working capital purposes, or I'm looking to raise 100 million for my working capital purposes. Can you help me find some money? So what will the investment bank do? They'll call up their investors and say, company X is looking, is issuing, because X, the company who's looking to raise money, they are the ones who are issuing the commercial paper. Company X is issuing commercial paper, 12-month commercial paper. They are looking to raise 1 year money. They're looking to borrow for 1 year. So what did the investment banker help do? The investment banker helped me know that company X is looking for money. So for that, investment bank will charge a fee from company X. Because company X is looking to raise money, I have money to invest. Investment bank will call me up and say, and they will call their big client base like that and ask everybody, including banks, they will ask everybody, company X is looking to borrow short-term money. Do you have options, or do you have investments to make? So, and then we'll ask, for example, from the investment bank, so what is the rate? And they'll give a rate, and then I might say I don't like that rate. Ask company X to increase it. The investment bank will negotiate on behalf of the two of us. They will negotiate the rate for us. So, like this, after that negotiation, if I'm happy with the rate, I'll say, okay, fine. At this rate, I'm willing to give 6 months money to company X. So then, what will investment bank will go and confirm the deal? Tell company X, okay, she's willing to lend to you for 6 months at this rate, right? And then company X will issue a piece of paper that says XPLC, commercial paper. So on 27th of August 2020, they issued this commercial paper, so in August, and this commercial paper says on 27th of November 2020, without days of grace, company X promises to pay back this much money to me, and then they sign it off. So it's an unsecured piece of debt with a tenor less than 1 year, right? This is, you can see, 3-month commercial paper. And any one of us can invest with this company When we invest in this company in commercial paper, what are we effectively doing? We are lending money to the company. So now the company has alternative avenues of raising money. They can go directly to the bank and ask for a working capital loan, or they can come to the capital markets and ask the investment bank to help find other investors who will invest with them. So investment bankers who will have a relationship with both the banks as well as other investors will talk to these people and see who offers the best rate and go to the company and say, okay, I can offer you 6-month loan at this rate via commercial paper. Any questions?
If company unable to repay again, so investment banking having any responsibility to?
No. Investment bank is simply an arranger of the transaction. Investment bank does not take responsibility in terms of the company being able to pay you back. But so no responsibility is taken whatsoever, for sure. It's the investor's responsibility, you and I, whoever is investing, the large fund managers who are investing, to evaluate, to make sure that the company is not going to default, because it is unsecured, right? But the investment bank also has reputation risk. If the company defaults, they will not be able to go back to the market again and go back to these investors and ask for money from these investors again, because the investor has got burnt. So because of that, if you're working with larger investment banks who have reputation risk involved, they are not going to be promoting companies that they feel, they might not know, but that they analyze. They will be promoting companies that they analyze to be better credit quality as well. Right? But certainly there is no guarantee. It's up to the investor. Buyer beware. It's up to the investor to do their own analysis to make sure that the company doesn't default. Good question. What else? That's it. So this is one of the smallest things, one of the smallest types of transaction or easiest types of transactions that an investment bank does. Okay, because there's nothing much to do other than helping two people meet each other in a commercial paper transaction. IPOs are more interesting for investment bankers, certainly a little bit more complex, right? IPOs mean initial public offering. Initial public offering. The first time shares or debentures, shares or debt, are offered to the public. That's what you mean by an IPO. The first time shares, new shares or existing shares. It can be shares or debt, because debentures also, you can have debenture IPOs offered to the public, right? So if a privately held company, for example, decides to go public and they want to get listed on the Colombo Stock Exchange, what will they do? They will offer their shares through an IPO. So an investment bank has a very complicated process when they do an IPO. They will, for example, if a company wants to do an IPO, first and foremost, there are so many different investment banks to choose from. So they will have to select what is the best investment bank to do this IPO with. You know, then the investment bankers list starts. You know, they will do the due diligence and advisory services for the company. They will decide on what price to come out for the IPO. What are the documentation that needs to be filed with the regulator? Any marketing that needs to be done for investors, the sale and listing, all of these things, this area is all done by the investment bank. So a company can decide to do an IPO 3 ways. Technically 2 ways: offer for subscription or offer for sale. And then you have this concept called introduction as well. When you do an IPO essentially is the first time your shares or debentures are offered to the public, right? So when we say offer for subscription, here the company is trying to raise money. So company is trying to raise money and they invite the public to subscribe to their shares. So what do? They issue brand new shares that were not in existence before in offer for subscription. They issue brand new shares that were not in existence before and offer them to the public, right? So imagine you had company A who had 3 shareholders before, right? So you have 3 shareholders who held 100% of the company. Now, what does company A do? Because they want to raise new money, they offer new shares to the public. Do you have the original 3 shareholders who, and let's assume that each shareholder had 100,000 shares. So the original 3 shareholders will still have 100,000 shares. And then the company will issue brand new shares. Let's assume the company issues 500,000 brand new shares and they'll offer it to the public. They'll say, we are doing an IPO, come and invest with us. Here's 500,000 new shares that we're offering. Come and invest in these shares at, let's say, 10 rupees each at this price. And then what will happen, if public is interested, they'll come and invest with the company at 10 rupees each. So 500,000 shares at 10 rupees each. How much is that? That's only ₹1 million that you're raising, right? But usual IPO size would be about 700 million, 500 million to the largest IPO done in Sri Lanka was 8 billion, right? So your IPO sizes can vary. But this is what we call an offer for subscription. In offer for sale, existing shareholders decide to sell out. So the company is not raising new money, existing shareholders are selling out. So this is offer for subscription. In an offer for sale situation, the same company, you have these 3 shareholders each having 100,000 each. Maybe this shareholder A decides to sell out. So he would offer, you have company A. So now B would still have 100,000 shares. C would still have 100,000 shares. But A's shares are now offered to the public. So if you and I are interested, we can invest in this IPO and we can essentially, A is going to be selling these 100,000 shares to us. So that is why we said it's new or existing securities. Offer for subscription is where it's new securities. Offer for sale is where existing shareholders decide to sell to the public. An introduction is a situation where you're simply, it's not an IPO, but it's a situation where you're simply listing this share in the Colombo Stock Exchange. So these 3 shareholders are the only people in the company. They simply say, I want to introduce my company to the Colombo Stock Exchange. Right. So they go and just list it in the Colombo Stock Exchange. So if the shareholders wanted to, after listing, they can decide to trade out the shares, but they're not offering it to the public. Let me show you some examples. You can see my screen, right? You're still following me on screen? So
Yes.
you can't see anything, just let me know. So I'm on the Colombo Stock Exchange site now. As you can see here, LCB Finance, IPO 2021. Initial public it went off. Expect oversubscribed in the opening day. So if we look at upcoming listings, right, expect IPO was offered to the public last Friday, 22nd, and essentially they are this company, and they said through an offer for subscription of 83 million shares at 8.4 rupees or 840 rupees per share to raise 700 million rupees for the company. Because it is an offer for subscription, the company is raising money of 700 million to be listed on the Colombo Stock Exchange. Issue opens on 22nd of October, and issue also closed on 22nd of October. And for this issue, you can see Capital Alliance and Asia Securities were the investment banks. So financial advisors to the issue essentially means they are the investment bankers of the issue. LCB yet to open. So you have LCB Finance, initial public offering. Invitation to invest in the initial public offering of LCB. Offer for subscription of 75 million ordinary voting shares. And if the share issue is successful, another 50 million ordinary shares at 4 rupees each. To be listed on the Duty Savvy board, and the investment bank is MDB Investment Bank. So let's look at one more, an offer for sale. A recent offer for sale was Jack. So I have Jack. You see here the initial public offering of 82 million odd shares through a combination of offer for subscription and 50 million voting shares. Sorry, 82 million ordinary voting shares through a combination of offer for subscription of 55 million shares at 27 rupees each and offer for sale of 27 million shares at 27 rupees each. So this company, Jack, essentially did an IPO where they partly raised money for themselves, for the company, right, by offering 55 million shares at 27 rupees each, and partly the existing shareholders sold out 27 million shares at 27 rupees each. So there's an offer for sale and offer for subscription. And here you can see CAL and NDB, investment bank, were the financial advisors or managers to the offering. So those are some examples. Introduction. So you can see here, introductory document. So EML was an introduction, right? Atara Capital was the financial advisor, meaning the investment bank of the issue. It's an introductory document because it was not offered to the public. Existing shareholders simply decided to list. It just says listing, not offering, listing of 90 million shares at a reference price of 2 rupees per share. These are some examples of how you come and try to raise money on the Colombo Stock Exchange. If you're doing an introduction, you're not trying to raise money. But when you're doing an offer for subscription or offer for sale, you're trying to raise money. And you saw under every circumstance, the investment bank is there front and center because they are the ones who are facilitating this whole process. So it's very important for a company as a first step to select the right investment bank. Okay. Because afterwards, it's the investment banker's job to do all of these things. So first thing to do is to select the investment bank. When you're selecting the right investment bank, some of the things that you're going to think about, you have to think about the investment banker's reputation. Reputation meaning, how many IPOs have they done before, their industry expertise, right? Quality of research, distribution and prior relationships. So these are 5 main areas I would focus on. What is this investment banker's reputation? Do other people trust this investment bank? Because if you're a company and you're going to somebody for help as a consultant, and that consultant is supposed to be finding people to invest with you, if other people don't trust the consultant, nothing will work, right? So because of that, reputation is very important, and which is why the investment bankers are careful of the people that they will deal with also, because their reputation matters for future businesses. Industry expertise. How many other IPOs have they done? Have they done large IPOs? So in Sri Lanka, the largest IPOs done so far was in 2005, the Dialogue IPO, 8 billion rupees. Every other IPO has been, obviously, that was the largest. Every other IPO has been lower than that so far. So I think we are on the verge of having a bigger IPO in the near future. But so you have to look at, when you want to do big IPOs, what is the reputation or what is the ability of this investment bank to do big IPOs? Sometimes when you want to do small IPOs also, that matters, because now we have the Empower board, which is for small investors, meaning SMEs, right, who want to raise money through issuing shares or debentures or whatever. So when you want to go and list on the Empower board, again, industry expertise matter, because there is a separate set of criteria for that. How is the investment research ability of this investment bank? How are they, how is it, are they able to do their valuations properly? Because there's a lot of mathematical, conceptual valuations and everything that will need to be done when you're doing this IPO. How is their distribution like? Distribution means how many investors do they know? Do they have a good, big investor base? Because these are the investor base that they will tap into and ask to come and invest in your company. Do they have foreign investors? Do they know foreign investors? That's what you mean by distribution. What is their prior relationship with you? Have you worked with them in the past? How have they been? So these are all things that you will look at or consider when you're thinking about choosing an investment bank. Who are the big investment banks abroad that you have heard of? Have you heard of any big investment banks abroad? When you say the term investment bank, who comes to mind? Nobody? Have you heard of Goldman Sachs? JP Morgan? Merrill Lynch? These are big names that you should have heard of. Hopefully you all have heard of Lehman Brothers. No? Lehman Brothers was the big investment bank that crashed. That was one of the first falls of and start of the global financial crisis in 2008. So these are big names in investment banking. Lehman Brothers doesn't exist anymore. They failed or they went bankrupt during the global financial crisis, the first bank or first entity to fail. But yeah, so big names in investment banking industry are people like JP Morgan, Goldman Sachs, Morgan Stanley, Bank of America, Citibank, Credit Suisse, Barclays, Deutsche Bank investment banking, right? So not Deutsche Bank per se as the commercial banking arm that you know of, but investment banking. So these are top tier. This is according to the Financial Times or FT. Globally, the top 10 banks. And you can see this is up to September 2021 for the first 3 quarters of 2021. And this is how, and look at the fees that they've earned and how they have earned fees. See, so for example, JP Morgan has earned fees of 9.3 billion for the first 3 quarters of 2021. Right? Goldman Sachs 8.5 billion, Morgan Stanley 6.6 billion. And how have they earned it? Mainly through M&A advisory, selling shares meaning IPOs, selling bonds meaning things like debentures and restructuring, syndicated loans, and from all of these, they've earned fees. Sometimes some of these investment banks are fund-based as well, so the fees will be different, but they've earned fees from each of these areas, and you can see how different investment banks have performed in different areas. In Sri Lanka, I've highlighted this is not an exhaustive list, right? There are so many different investment banks providing different types of services. Some investment banks provide very narrow scope of services, meaning they will only do, for example, issue commercial paper and securitized paper. That's it. Right? Some investment banks will do all of these gamut of services. They're more broad. Right? So you have many different investment banks. So I've just highlighted a few and some few big names. And with these big names, also try to show it to you in 2 different columns to help you understand the types of investment banks that are there, right? So for example, on this column, you can see that Bank of Ceylon's investment banking division. Commercial Bank has an investment banking division. NBSL has a corporate advisory and capital markets division. People's Bank has an investment banking division. So within the bank itself, there is a separate IB division who will do these or engage in these services. If you look at the other side, you see equity partners. Equities, you should know who and who. Equity? Any idea? Some of you all should definitely know. No idea? It's a partnership between DFCC and HNB, right? So equity partners, you have, it's an investment bank in Sri Lanka. NDB Investment Bank is an investment bank in Sri Lanka. They are separate entities, separate subsidiaries of the banks. And then you have these 3 examples, right? Because these are selected investment banks. These 3 examples, Asia Securities, Capital Alliance, First Capital, they are non-bank investment banks. Equity is a partnership between HNB and DFCC. NDB Investment Bank is obviously a subsidiary of NDB. Then you have all these investment banks that are divisions of all of these banks. And then here you have other investment banks who are not, who have no affiliation to banks at all. So you have all these different types of investment banks that are there, right, in Sri Lanka. And this is not an exhaustive list. There's so many more. So it's up to you to choose the right investment bank for you. So before I go on to this due diligence and advisory, I just trying to figure out how to do this. Right? Okay. Before I go on to due diligence and advisory, one of the things that I want to tell you was, right, when you're raising money through an IPO, you can raise money either through shares or through debentures. Either through shares or through debentures. Both fall under the initial public offering process. When you're raising money through shares, obviously, you know, if your company is offering you shares of that company, you are essentially going to become a shareholder of that company. You're going to become an owner of that company. So when sometimes you're not directly investing in an IPO, you're buying shares in the secondary market. So just because you're trading in the secondary market doesn't mean that you are not becoming an owner of the company. But then at that point, when you're trading in the secondary market, you're not giving money to the company. You're simply, shares are exchanging hands. So what I mean by that is, when a company wants to raise money, they will come and offer new shares or existing shares to the public, right? And the public can invest in these shares. Once you invest in these shares, so once with the public invest in these shares, so for example, you saw at 4 rupees or 10 rupees or whatever, a certain number of shares have been offered. And when you invest in this, the company is going to raise money. 80 million shares at 4 rupees each means the company is going to raise 320 million rupees worth of money. Once the shares have been offered to the public, the shares get listed on the Colombo Stock Exchange. Then the shares will get traded from one person to the other. In that process, the company obviously is not going to make any money. There, the shares simply change hands between people, right? So trading in the secondary market is different. Raising money through an IPO is different. But whichever way, when you're offering shares to the public, what are you saying? Come and give me money, invest with me as a shareholder of the company, as a shareholder with voting rights, ability to get dividends. Right? So although you don't exercise control regularly, you can elect a board to control the company. So you are an owner of the company even if you hold 100 shares. When you're investing in a debenture, you're giving a loan to a company, just like commercial paper. In a debenture, you're giving a loan. Right? In commercial paper, it was a short-term loan. Debentures are long-term loan, more than 12 months. So typically in Sri Lanka, it is required that a debenture has a minimum of 2 years maturity. Right? So debentures are what? Debentures are companies coming to the capital markets and asking to borrow money from you and me. And what are they saying? Lend me money. I will give you a certificate. This certificate is scriptless, meaning it is not a piece of paper, but it is computer form, right? Give me money in the form of a loan. So where you're taking long-term loans from the public, we call them debentures. And when you invest in a company's debenture, when a company comes through an IPO and asks for money through a debenture, you are essentially becoming a creditor of a company, of the company. Any questions?
So if we issue a debenture to that investment banking, that investment banking same like agent, same like the commercial paper.
Same like the commercial paper. So what the investment bank will do, whether it is shares or debentures, they will facilitate that process of listing. So once you select that investment bank, the investment bank will do all of this, either for debentures or for shares, to facilitate that process of listing.
Normally we can observe some banks can issue a debenture through them, no? Other than investment bank.
Banks will issue debentures. Who will help them issue the debenture? So the company issues debentures or bank issues. So you have commercial bank has issued debentures, HMB has issued debentures, Ceylon Bank has issued debentures. So many banks have issued debentures, but who helps them issue the debenture?
So that's the investment bank.
That's right. That's the investment bank that helps the process. What do you mean by helping the process? So it's not that every single debenture that is carried out in the market needs to have an investment bank. There is nothing like that. If you think the debenture, because unlike a share process, issuing a debenture is an easier process. Okay. So because of this, a bank is a big enough entity, they can do it on their own without an investment bank also. But an investment bank will help them do the legal documentation, talk to clients, market the debenture, help them find the price for the debenture. So the banks also, like I showed you, have their own divisions, investment banking divisions internally, right? So because of that, even though you might not see, it's the bank's investment banking division that will be facilitating that process.
Same like in equity and share issuing. So that means all the groundworks done by investment bank, and share brokers can issue the trade in their market. Am I correct?
Say that again. Groundwork is done by investment bank. That's correct.
Investment
And then
then share brokers involving to that trade
trading in
that
the market.
market.
Yes.
Okay, right.
So introducing it to the market, listing it in the market, up to that listing process, the investment bank gets involved. And then afterwards, when you're trading in the secondary market, any secondary market activity, this is where the brokers get involved. So let me just very quickly run through these activities that are done by investment banks. So once the company has selected an investment bank, the next step is the investment bank will start its own due diligence and provide advisory services, right? Due diligence means they will do a full review of the company. Sometimes you know the company, sometimes you know the bank. Most of these areas that I'm discussing now, these 2 to 6, right, is mainly for shares, right? The examples I will pull out are mainly for shares. Doesn't mean that it is not true for debentures, but in debentures, this process is much more simple. In shares, this process is a little bit more complex. So I will pull a lot of examples for shares, but doesn't mean that everything I discuss isn't true for debentures as well. So when you talk about due diligence, what you're saying is the investment bank is doing their own analysis of the company. Before they can go and sell it to the public, they need to know what is this company. So that's where you do a due diligence process. They talk to the management of the company. They want to make sure that the organization is in good standing. You know, what have they done before? Have they failed in anything? What is the financial information, taxes? So just like a normal, you know, when you go to a bank and you ask for a bank loan, here you're not asking for a loan, but you're asking people to come and invest and take ownership of the company. You still need to do your groundwork. You need to know what is this company you're investing in. So the first part of the groundwork is done by the investment bank, because they are the ones who are going to sell the company now to the public. So therefore, the investment bank will go through, and they should go through if they are a good investment bank, all of these different things, understand the company thoroughly, look at their product lines and services, you know, what are their assets, intellectual properties, licenses, permits, any legal battles that they have, what is operational in that company, what is not, you know. So these are things that they will do. And then they will also give advice to the company. They're here to determine, for example, you know, should you go for equity or debt? Sometimes the company will come to the investment bank and say, I want to issue shares. Sometimes it can happen that the investment banker will go through the company, do the due diligence and look at it and say, you're a little too early to come in for shares. People don't understand what's happening in this company yet, or you're not making enough profits yet to come and to go and market it to the people. Maybe we should offer a debenture instead. So it's up to the investment banker not to do just what the company tells them exactly. It's up to the investment banker to help the company understand what is the best way for them to proceed. They will also help in terms of, you know, pricing. What is the price to offer this to the public at? What is the quantity of shares that we should offer? What time should we come out in the IPO, for example? Because, you know, every single day is not a good day for an IPO, right? Sometimes you see that the market is falling. And when in these types of markets, sentiment is not good. When people look at the market, they only see red. Market is falling. They are losing money. You don't want to offer a new share to the market when people are losing money in their own existing shares, right? So it's companies are experts on their own field, or banks are experts in their own field, but they are not experts in the market. Investment bankers are supposed to be experts in terms of market timing to help the company determine what is the best time to offer the shares to the public. So a good time to offer the shares to the public is, you know, periods like this when the market is doing really well, people are making money, people want to make more money. This is the period. That's why you're seeing this year, we are seeing such a lot of IPOs coming out into the market. One of the reasons is We have a good window of opportunity that has opened up right now. So investment bank can do this process, offering shares on either a best efforts basis or firm commitment basis. What that essentially means is, if the investment bank agrees to take on the assignment of this company, they will say, okay, we take on the assignment and we do it on a best efforts basis. Best efforts basis means we will look at the company, analyze the company, recommend timing, quantity, price, all of this we will market to our investors. We'll give it our best effort to sell all your shares. But sometimes, for certain things beyond our control, we might not be fully successful, in which case you might not be able to raise all the money that you want to. Okay. So what that means is, if a company, in my previous example I said, it wants to raise, let's say, wants to raise 800 million, the investment bank says, okay, I'll do it on a best efforts basis, meaning you want to raise 800 million, I'll talk to my clients, I'll pitch the company, I'll do the due diligence, do the prospectus, do the regulatory filings, all of that. But, sometimes clients might not like the company, in which case there is a chance that your IPO might not be fully subscribed. What do you mean by a fully subscribed IPO? Everything that you are offering is taken up by the public. If every share that you're offering is taken up applied for by the public, that we say is a fully subscribed IPO. IPOs can be fully subscribed, oversubscribed, or undersubscribed. A fully subscribed IPO means you're offering 80 million shares at 10 rupees each to raise 800 million rupees. Right. Every single share is exactly applied for by the public. Oversubscribed means the company is offering 80 million shares. There is so much demand, so many people want to buy this company. Let's say 200 million share applications. 200 applications for 200 million shares have come in. So 200 million shares into 10 rupees means 2 billion worth of applications have come in. Company only wants to raise 800 million, but there's so much demand, the IPO is oversubscribed because more applications than what is required have come in. Undersubscribed is, you can understand, the exact opposite, where you want to raise 80 million shares, where you want to raise 800 million rupees by issuing 80 million shares, but only 20 million applications have come in. So you can only raise 200 million. You fail or fall short of your target to raise the entire 800 million. So the investment bank says, we do it on a best efforts basis. When investment banks agree to do it on a best efforts basis, they will give their best effort to sell, to make sure that the IPO is fully subscribed or oversubscribed. But there is a risk that the IPO might be undersubscribed. If the investment bank gives a firm commitment, okay, that means the investment bank now starts to work with who we call an underwriter, which may be the investment bank itself, or it could be an independent third party. Excuse my handwriting. You start to work with an underwriter. Okay. When you're working with an underwriter, which might be the investment bank itself, like I said before, if the investment bank is fund-based, or a third party who is working as the underwriter. When you say a third party, usually it's another bank. It's a bank, not an investment bank. So a third party underwriter might be a bank. Here, what would happen is, if you fall short, the underwriter gives a commitment that whatever the shortfall, the underwriter will buy. So you want to do company wants to do an 800 million issue and offer 80 million shares to the public, but public is not interested in this company, so they only subscribe or apply for 20 million shares. There is a shortfall of 600 million, right? Through the public, you only raise 200. So then the underwriter agrees to buy the remaining 600 million so that the company is guaranteed that they will be able to raise their 800 million. So in a firm commitment underwriting, the company knows that they will be able to raise the money that they want to raise, but in the best efforts underwriting, the company doesn't know, but the investment bank will do their best to drum up interest. Let's look at an example.
Then who will pay to the underwriter? Investment bank or customer?
Company.
Company.
Yes. So that's why you don't have a lot of underwriting in Sri Lanka. In the US, it happens the other way around. In the US, most of the time it's underwritten. Issue is underwritten, where the investment bank, which is fund-based entity, will buy all the shares as the underwriter, and they will sell it to the public. So they are, because the company is happy because they are guaranteed that they're getting their money. Okay. So what will happen abroad is, in the US, it's not that every single time it will happen, but most issues will be firm commitment basis. And their underwriting process is a little different. So you have the company who wants to raise 800 million. So the first thing that happens is JP Morgan or Goldman Sachs or whoever the investment bank, these investment banks, unlike in Sri Lanka, fund-based. So because they are fund-based, they will first buy the entire issue from the company. And then they will sell it to the public. So they might, for example, company wants to raise 800 million, 80 million into 10 rupees a share, right? So they might buy, let's say, for example, 80 million shares at 950. And then sell it to the public at 10. They take the risk that sometimes the public might not want the shares, in which case they are stuck with it. Okay. This is what happens in the US process. They will buy the entire thing in a firm commitment underwriting and then on sell it to the public, and they will keep a margin for that. So your fees are higher in a firm commitment underwriting because you see 50 cents is kept with the investment bank in my example as fees. And the company, although they are raising everything that they want to raise, less fees. Right. Anyway, you have to pay fees, no? Even if it's best efforts, no matter what, the investment bank will charge a fee. But if it's underwritten, the fee might be slightly higher than if it's best efforts. Let me just show you an example. Going back to CSC again. This is an issue that I remember was underwritten, if I remember correctly. Let's see. RI property. So you can see the two investment banks were Commercial Bank and NDB Investment Bank. So lead manager and joint manager, right? The Commercial Bank was the lead investment bank to the issue, and NDB Investment Bank was the joint manager to the issue. You can have equal investment bank managers to the issue, or you can have one person who's leading the issue and the other person being a joint manager. So in this, I remember there was underwriting involved. So minimum subscription and underwriting. So you can see here, the company has entered into an underwriting agreement with Commercial Bank. In the event of any undersubscription, Commercial Bank, the underwriter, will subscribe to a maximum of 37.5 million shares at the offer price. So they will give up to 300 million rupees. They will underwrite of the issue up to 300 million rupees. So if you look at this issue was 120 million into 8. So how much is that? That's about 960 million rupee issue. And commercial bank has agreed to underwrite up to 300 million of the issue. So if the issue falls short, commercial bank would have, so the issue didn't fall short. So the commercial bank didn't have to buy the remaining shares, if I remember correctly. But if it did, commercial bank would buy any remaining shares up to 300 million.
I mean, so that means normally the public investors, they because of their investments, because of that underwriter.
Say that again.
So that means somebody invests for the share or debenture,
yes.
because of that underwriter, because they go through that underwriter, who is the underwriter, and if the underwriter, commercial bank now take it over that underwriting 3 million, that's why they invest in that.
No, not necessarily. No, because so the company has an underwriter. So in Sri Lanka, underwriting is different from the way that I explained in the US, right? In the US, they buy the entire share, like Goldman Sachs or JP Morgan, whoever is doing the IPO would buy the entire issue and on-sell it to the public. But in Sri Lanka, underwriter buys only if undersubscribed. So if you offer it to the public and the public doesn't, there's not a lot of interest. So you want to raise 800 million, but the applications only come for 200 million. Then the underwriter agrees to buy the rest of the 600 million. The public knows because of the prospectus that there is an underwriter, but they don't apply for the issue because of the underwriter. They apply for the issue because they are interested in the company or not interested in the company. The underwriter is there just as a safeguard in case the public is not interested in the company. The underwriter is there to make sure that the company raises all the money that they want to raise. Okay. So, investment bank will also determine pricing. What they will do is they will do a valuation of the company. Okay? When you're an investment bank, they will do a valuation of the company because they are talking one-on-one with the management, right? They have a lot of inside information in terms of, if you're a proper investment bank, you would have very detailed conversations with the management, try to figure out what their plans are going forward. So based on those plans, the investment bank will forecast probably like a 5-year profit and loss statement, a 5-year balance sheet, a 5-year cash flow. And then from there, we'll try to come up with what are the expected, what we call free cash flows over the next number of years and forever. We'll try to forecast those cash flows. We'll try to discount those cash flows to come up with what is the fair price for this company. What is the fair price that you should pay to buy this company? So investment banks will do a valuation. The price will be based on 2 things. One is the value of the company through the valuation done by the investment bank. Right? These valuations can be PE-based valuations. These valuations can be price earnings based. It can be or some type of multiples based, right? You know, price to book value, price to earnings, something like that, based on peers, similar other companies. Or it could be DCF, discounted cash flow based valuations, like I told you, where you try to forecast the P&L, balance sheet, cash flow statements, and then find the present value of these to come up with what is the fair value or the price that you should pay to buy this company. So using all of this, you come up with the value of the company, and you also have to look at the expected demand for the securities. Because just because you think this company is worth 80 rupees if people are not interested to pay 80 rupees to buy it, it's not worth it, right? So company might be worth 80 rupees because the company has plans to grow, and they, with that growth, their worth is going to be there. But you have to be able to convince and create demand to reflect that worth of the company as well. So that expected demand for the securities also plays a big role. So using DCF methods like NPV or relative valuations, you come up with the price, but sometimes investment banks will do certain things to change around the prices so that it looks attractive to the public as well. So say, for example, a company has, you come up, the investment bank does the valuation, and it comes up, and the company has 1 million shares. Okay, 1 million shares, and investment bank's valuation says this company is worth 800 rupees per share. Imagine going to the public and saying, pay 800 rupees for one share. In your head, it seems a little expensive, right? In your head, it seems a little expensive. So the company is worth 800 million. If you look at, the company has 1 million shares, 800 rupees per share, the company is worth 800 million. But the investment bank knows you can never go to the public and offer the company at 800 rupees a share, because public is going to say, no, this company is too expensive. So what will the investment bank do? They work with the company, and they might do a share split, where they say, let's split this 1 million shares to 80 million shares, 1:8, right? So you split the shares to 80 million shares, and now your per share value suddenly becomes 10 rupees. Your company value remains the same. You didn't change the value of the company. You changed the number of shares so that you change the value of the share. You offer the public a 10 rupee share, suddenly that looks cheap. Same company, but you're making the share look and feel more affordable. So these are some tactics that you might use, and these are things investment banks will know by the fact that they've been in the market. You know what is something that will make the public excited and what is something that will not make the public excited, and how are ways that we can change around and make the company look and feel better to the public in a way that they are comfortable to invest with the company. So they can do any of these, and then they can look at the pricing and offer that to the public. So some examples of pricing, right? You can see here, Enforce an IPO that came recently, offer for subscription at 16 rupees each. So most of the time, a price is fixed. You offer it to the public at a fixed price, right? Sometimes single price. Sometimes we had this phenomena in 2004 to up to about 2006-07 in Sri Lanka. We saw a few offers that tried to do the Dutch auction method, right? So the dialogue IPO, Hemas Power, LIOC was the first one that offered this. They offered investors a range of prices. So they offered investors a choice. If you want to invest in this IPO, you have the choice to invest at 8 rupees, 9 rupees, 10 rupees, 11 rupees, or 12 rupees. It's up to you. So they gave investors a choice of what price to invest in the IPO. So why do you do something like this, where we call this a Dutch auction method? You do something like this to generate interest. Because in a hot IPO with a lot of interest, what will happen? Investors will, usually what happens in this type of pricing is you start accepting applications from the highest price, because the company wants to raise as much money as possible, right? So you start accepting applications from the highest price to the lowest price until the company raises all the money that they want. So I told you Dialog did an IPO for 8 billion. So when they did the IPO, if I remember correctly, they got applications worth of 56 billion. Right? So they got applications worth of 56 billion, but they only needed to raise 8 billion. So what did they do? They started counting applications from the highest price downwards. So once you reach your 8 billion target, all other applications get rejected. So what do? Anybody who applied at 12 rupees, they accepted first. Then you accepted anybody who, if your 8 billion target was not reached, you accepted people at 11 rupees. If your 8 billion target was reached at that time, anybody else got rejected. Okay. So actually, they raised all their money at 12 rupees. Okay. So that was a Dutch auction method, and this method was used in Sri Lanka a little bit during about 2004-2006-07 period. There were a few IPOs that came out using the Dutch auction method. But since then, it has dwindled, and you don't see a lot of IPOs anymore. Most IPOs go on single pricing. Typically, IPOs are priced at a discount. Why do you think that is? Why do you think that is? The first time a share is offered to the public, usually an IPO is given at a discount. Because it's a company's way of saying, come and invest in my share. I'm going to give it to you at a discount because it's the first time I'm coming to the market and I really want you to invest in my share. So therefore, I'll give it to you at a price a little lower than what it is worth. So even though this company is worth 800 million and I should be offering you shares at 10 rupees, I'll offer you the share at 8 rupees each. So I'm giving you a 20% discount from what it is worth. This doesn't happen all the time, right? But this typically is a way of companies thanking their investors for coming and investing with them, companies enticing investors to come and invest with them. So IPOs typically you will see are priced at a discount. But like I said, this is not always the case, because as IPOs get hotter and hotter and hotter, the IPO market becomes more and more, there are more and more investors demanding for IPOs. Then what happens? That discount disappears, because companies know they don't need to offer investors discounts. Investors are anyway looking to come and invest in new companies. Then the companies will raise money at correct prices, and sometimes they might even raise money higher than what is the correct price, because they know they can get more. So, I mean, investment banks will help the company do the documentation and regulatory filing, right? For example, you have to file there's a lot of things that need to be filed with the SEC, with the Colombo Stock Exchange and the Securities Exchange Commission. So the regulator, when you're listing in the Colombo Stock Exchange, the regulator is the Securities Exchange Commission. So you have to send to the Securities Exchange Commission as well as with the Colombo Stock Exchange. You have to file all these things. You have to give a board resolution saying the company is going to go for an IPO. There's nobody who doesn't want to do an IPO inside the company. The company's articles of association allow for an IPO, all of this. And then you also have to provide prospectus. First a draft prospectus and then the full prospectus. What is a prospectus? All those documents that I was showing you earlier, when I go to the Colombo Stock Exchange website, what were those? Those were prospectus. Right? What is a prospectus? It's a legal document. It's a legal document that contains all the information about what is being proposed in this IPO. So whether it's a debt IPO or an equity IPO, there will always be a prospectus that defines the terms and conditions of the IPO. And who writes the prospectus? The investment bank, with obviously the input of the company. Investment bank will gather, compile the information, put it together, the company will approve it, so the investment bank will facilitate that process. Investment bank will help gather all the documentation together, take it, give it to the SEC, coordinate with the SEC to get the approvals, coordinate with the Colombo Stock Exchange to get the approvals. All these regulatory filings, the coordination will be done by the investment bank. And then they'll do marketing and placement, right? Marketing and placement seems very basic, But this is the most important part. This is where you generate interest for the IPO. If it's a debenture IPO, marketing and placement is also about figuring out what is the correct rate for the debenture. Okay, so for example, it's also about talking to the investors before the prospectus comes out. It's about talking to the investors and finding out, I have a company, XYZ, they might not disclose the name, but they might say, there's this company XYZ, which has this quality credit rating, who's looking to come to the market, raise a 5-year debenture. Remember, I told you debentures are long-term debt instruments. So they are trying to raise a 5-year debenture. They are hoping to come at this rate. So the investors will say, I don't think that's a good rate, or oh, that's a great rate. I'm interested. I'll put a 500 million. So this is where the investment bank will try to gauge how the market will react to the IPO. And also, especially in equity issues, there will be a lot of marketing, which we typically call roadshows. The word roadshows come from it's actually US terminology, right? Because US, US is such a vast country, right? You can't just drum up investor interest in New York or just investor interest in a small segment and expect the IPO to be oversubscribed or fully subscribed, especially for big IPOs. So you would go from you will do investor one-on-one meetings as well as investor presentations to groups of investors, and you will be across the road. You will be driving a long distance to do all these presentations. That's where this road show type of wording came into play. So essentially, what do you mean by roadshow? Where you're doing one-on-one meetings with prospective investors or groups of investors to try to generate interest for the IPO. And finally, you sell it. You sell the IPO. You offer it to the public. And on that IPO day, the IPO may be oversubscribed, undersubscribed, or fully subscribed. I showed you earlier. That the stock exchange, as soon as you go here, I think the next one, it says expect IPO oversubscribed on opening day. So the opening day of that expect IPO was Friday, I told you. So on the first day itself, there were enough applications to fulfill or cover the amount that they were trying to raise. So because of that, there was a notice that went out saying IPO is now closed. It's not accepting any more applications because it is oversubscribed. So usually investment banks love it, and companies love it if they can get the IPO oversubscribed on the first day itself. It's like performance metric for the investment banks, because it's their way of saying, I've done so well for the company, I've marketed this so well that the IPO has got sold in the first day itself. Right? So ideally, that's what the investment bank wants. Unfortunately, obviously, some issues don't get fully subscribed, or they get undersubscribed, or they take some time to get subscribed. So these are things also that can happen. Okay. So before we go on to the next section, we'll take a break, but just to show you very quickly some statistics. Oh, yeah. Sorry, 1 second. So sale and listing, once you do the listing, remember, investment banker's job is still not over. Before the listing, after the listing, the investment banker's job is over, right? But before the listing, after that first IPO date, once you get the applications, the investment banker will still coordinate with the registrars to make sure that all the applications are in order, to make sure that in terms of refunding the checks and whatnot, and then help the company in deciding on the basis of allotment. Basis of allotment means if the IPO is oversubscribed, let's say, for example, my 800 million IPO, I got 2 billion worth of applications. How do I decide who gets how much? So then the company has to decide the basis of allotment, the basis of who gets how much, but the investment banker will help in that process. right? And sometimes it's good to have aftermarket support, after IPO support, meaning the first day the share gets listed on the Colombo Stock Exchange, ideally another performance metric is that the share price should rise. Investors who invested in this on the first day itself should be able to get a return. That's another performance metric. So for the investment bank, they still need to make sure, they can do follow-up roadshows with other investors to drum up interest, so that investors who want to exit on the first day, there are other investors who are waiting to buy. Right? So these are things that investment bankers can still do even more to drum up that interest for the IPO. So you can see here, we haven't had a lot of equity IPOs. 10-11 was where we had a lot of equity IPOs that were happening, right? And then slowly and slowly, interest started to come down. Why? Because after around 2011-12, I was telling you those IPOs should be priced at a discount. But the IPO market was so hot that discount started to disappear, right? And companies started to become overvalued, the IPOs that were coming out. And investors started to lose money on the first day. So with investors starting to lose money on the first day, investors became disappointed in IPOs, and it became harder and harder for new companies to raise money. So because of this, interest for IPOs, in equity IPOs, came down. 2021 is a different story. 2021, again, you're seeing interest has increased. I don't have the numbers here, but so far itself, we've had about 5 IPOs this year. Debenture IPOs, on the other hand, are a different story. Do you see here? 2013, if you all know, government gave certain concessions for debentures, tax concessions. So 2013, 14, 15, I believe, a lot of debentures were issued because of these tax concessions. Afterwards, these tax concessions were taken out, so we saw the debenture numbers dropping a bit. But still, you see that there are quite a lot of debenture IPOs. And look at the numbers. See, although equity IPOs are more interesting, we have had much more debt IPOs in Sri Lanka in terms of value than equity IPOs. Do you see the amount of debentures? 83 billion worth of debentures raised in 2015, 78 billion worth of debenture money raised in 2016, right? So a lot more money raised through debentures in Sri Lanka than equity. And on this side, I'm just showing you the first day gain on an IPO. So the light color is showing you, typically over the years, you will see on average, IPOs have given you 12%, 11%, 12% returns on the first day. So this is not Sri Lanka, this is US. These two statistics are Sri Lanka, these statistics are US. Similarly, stock price gains of internet companies on the first day trading. You can see eBay, Yahoo, Google, all of these have given you first day massive gains. But a hot IPO like Facebook, which is much sought after, would have been priced just there, which is why on the first day investors didn't make a lot of gains. So, sorry, I took a little bit more time than I anticipated to finish off this section. I wanted to do that before the break. We'll take a break and come back to the next part. If there are any questions, I can answer and then take a break. Any questions? You want to take the break? It's 3:30. Let's come back at 3:45. So we did a little, I gave you a little flavor of the types of things investment banks will do when they are helping companies raise money through IPOs, either through debentures or equity, but via an IPO. Any questions in this area? So another broad area of how investment banks will help companies raise money is through structuring securitizations. Securitizations is another form of loan. It is a structured loan where a company is again going to the capital markets trying to raise money from investors, not necessarily banks. Banks will also be one of the investors or can also be one of the investors. But the securitization is essentially a loan that is secured by the strength of future receivables. So what happens in a securitization? If I was to explain what happens in a securitization, essentially in a securitization, what you're trying to do is use a company's cash flows on the revenue side, use the company's cash flows and secure the company's future cash flows and issue a loan backed by the strength of those future cash flows. So what that means is, now if you take a traditional loan, you have to depend on the company's profitability to pay for the company to pay you back, right? So if you, for example, a company has a certain amount of revenue, they'll have their cost of sales, GPs, and they'll have their distribution expenses, they'll have their administration expenses, pay their salaries and whatnot, and in between they will also have to pay their finance costs, their loan charges, and then essentially after they pay this, they will make a profit or loss. But you see that you pay your loan when you take a bank loan or any typical loan, you will pay along with all these, other salaries, sales and marketing costs, your costs of sales in generating and all of that. So your ability to pay back your loan also kind of depends on your profitability of the company. Okay. In a securitization, what we try to do is we try to capture the loan repayment at the revenue level itself. So we try to capture the cash flow at the revenue level. So we don't care how profitable the company is. We don't care what about the company's GP margins, what about the company's distribution costs, salaries payable, whatnot. We try to secure the cash flows at this revenue level to pay back the loan. So how do we do that? Typically, securitizations work for companies that have regular, identifiable, legal cash flows. So what that means is essentially, if you look at, let's say, for example, a typical example of a company that does securitizations are finance companies or leasing and finance companies. These are not the only companies that do securitizations, but these are typical examples. So you take a leasing and finance company, you know that these companies, how do they generate income? They have a typical pool of vehicle leases that they have given, right? And these vehicle leases that they have given, every month, these people who have taken these loans will pay back the company. So you have the finance company, call that finance company A. Finance company A has given out a typical, given out vehicle leases, right? So given out leases on a set of vehicles, and every month on their portfolio that they have given out, there's a certain amount of money that will come out. So if you've given out leases, some people will be paying, let's say, 50,000 rupees a month. Some people will be paying 12,000 rupees a month. There will be some lease payments that are like 3,000 rupees a month or 100,000 rupees a month. So you have all these different lease payments that come into this portfolio of company A. What in a securitization, what we try to do is, of that entire lease portfolio, I try to identify one single set, right? So I try to identify this one set of leases and cordon that set of leases off. So this, let's say, for example, I don't know typically how many leases a company would have, but let's say company A has given 2 million leases through its whole company. And let's say out of that 2 million leases, they identify 10,000 leases that they want to cordon off and use in a securitization. So what will typically happen in a securitization in Sri Lanka, and this process is different, slightly different abroad, so I'm talking about the Sri Lankan experience. They'll take this identified lease portfolio and pledge all the cash flows, all the future cash flows from this lease portfolio to a trust. We call this trust an SPV, a special purpose vehicle, an SPV. So why do we call it SPV? Because this trust has been established especially for this purpose, right? In simple terms, a special purpose vehicle, which is there only established to essentially pledge, in this case, pledge in the Sri Lankan experience, pledge this set of lease receivables. So once I pledge this set of lease receivables, essentially what I am saying is these lease receivables of these 10,000 loans belong to the trust. And backed by the strength of those lease receivables of that portfolio that has been cherry-picked and identified, the trust issues a debt, unsecured debt, right, on behalf of the company. They borrow money from investors. They say, we have this set of leases that have been pledged to us, and from this set of leases over the next 5 years, we are going to get this much money every month. And backed by the strength of those cash flows that I'm going to get every month for the next 5 years, I want to borrow money from you. So the investors will give money to the trust, which will pass it on to the company. So the company, what is it doing? The company is taking a loan. How is the company taking a loan? By pledging its future cash flows from the revenue level itself. Because what is this company's revenue? It's a finance company. It earns revenue from its lease receivables. So from the revenue level itself, it's pledging its cash flows. It's a set of cash flows of an identified portfolio to a trust. And the trust, backed by the strength of the receivables of these cash flows, is issuing a piece of paper to the investors, just like that commercial paper I showed you, which is a promise to pay back, but now the commercial paper was unsecured. This is secured. Secured by the cash flows of this identified portfolio. So it issues a piece of paper to the investors that say, I promise to pay you, the company promises to pay you, based on this set of cash flows, this amount of money on this date when it matures. So backed on that piece of paper, the investors will give money to the trust, which the trust will pass on to the company. This process is a very simple explanation of what is a securitization. It is a kind of a secured loan, securitization, a kind of a secured loan, but it is not secured by assets. It's secured by cash flows. What is being pledged to the trust, not the vehicles. The vehicles are pledged separately, but what is being pledged to the trust is the cash flows generated by these portfolios that has been identified. So now the company has raised money, and every month what will happen? All the cash flows of these 10,000 vehicles will come to the trust, and the trust will use that money that it receives to pay back the investors on their loans. So every month for the next 5 years or 4 years or whatever the period of the loan, the trust will use the cash flows generated by this portfolio to pay back the investors. Technically, we say securitizations are bankruptcy remote. Why? Because what we are trying to say is, even if the finance company goes bankrupt, the securitization structure remains. We don't care if the finance company goes bankrupt, because these people who have taken loans from the finance company still have to pay back the finance company, even if the finance company goes bankrupt. Therefore, this portfolio's cash flows over the next 5 years will still remain, and the investors will still get paid back. So that is, in very simple terms, the mechanics behind a securitization. Any questions? No questions? So any company that has an identifiable set of cash flows can do a securitization. So, what will happen? You have this issuing company, the company that wants to borrow the money. They will mortgage the receipts of whatever the underlying assets to the trust, the SPV. And the SPV will issue trust certificates to investors backed by that consideration of that mortgage and pass on that money to the originator. Every month, what will happen? This is the first transaction, and every month, what will happen? The company will collect the monthly rentals from that pool that has been mortgaged to the trust and pass it on to the investors. That's how the investors get paid back. Now, where does the investment bank come into this transaction? Where do you think the investment bank comes into this transaction? Yes? What do you think? Well, firstly, you should understand at a very basic level, the investment bank will help find investors for the company, right? To invest in this securitization. Because what is the first thing that the investment banks do? They act as the arranger, the agent, to find the investor. So they are the people who will talk to the investor, negotiate the terms and conditions with the investor, and help find investors to invest in these trust certificates. At a basic level, that's the first thing they will do. Also, if you think about what's happening in the securitization, I was saying, you identify a pool, right? You identify a pool of vehicle loans, right? So this pool of vehicle loans that has been identified, the investment bank will coordinate with the auditors to do the due diligence, to make sure that the company that's giving this set of vehicle loans is giving everything that needs to be given. And the loans are in good standing order, right? So we are not pledging securities, we are not pledging assets in this pool, we're pledging cash flows. So we need to know, we need to make sure that the pool that has been identified of this company, the pool that has been identified, these loans are in good condition. The people who have taken these loans, who have taken these leases, are paying back. And there are no defaults. And if there are defaults, the defaults are, less than, for example, less than a stipulated time period. Like, for example, it's not a default, but they are in arrears, and that arrears sometimes, let's say, for example, is less than 2 months. These are things, these are due diligence that you have to do. So the investment bank will coordinate with the auditors to do this due diligence. You can see this is a complicated structure. There's a lot of legal documentation that will be required. The investment bank will coordinate with the legal department, with the lawyers, to get all the legal documentation in place. Because you have to identify this pool, you have to pledge this pool, there is a mortgage bond in place, there is a trust in place, there is a trust deed in place. There's a lot of legal documentation that needs to get through this whole transaction. Investment bank will coordinate with the lawyers to get everything done so that it meets the expectations of the investors as well as the issuing company. Also, investment bank will structure the trust certificate. What does that mean? In a typical pool like this, what would happen is you would model the cash flows, right? You would look at, okay, over the next, so I have a set of vehicles that I am going to identify, leases, that I'm going to identify these 10,000 leases that I'm going to identify, and I want to be able to sell it to the investor. So it's the investment bank who will look at and model and try to figure out how much money can the company raise by doing this issue, at what price must they issue it to the investors, what is their cost of funds going to be. All of these things will be done by the investment bank. So, for example, let's say the investment bank will model over the, let's say, the next 5 years, because typically a lease is for 5 years. Over the next 5 years, every month, what is the cash flow that is expected to come in to this from this portfolio. So in the first month, let's say this portfolio, you're expecting cash flows of, let's say, 80 million. How are you expecting cash flows of 80 million? All the lease rentals that belong to this portfolio, the addition of all the lease rentals are 80 million in the first month. This might be repaid, because you can't get, it's not like on one day the company will be giving out exactly 10,000 leases or something like that, right? You'll be identifying leases that have been given out at different times. So some leases would expire earlier, some leases would expire in 5 years, some leases would expire in 4 years, some in 3 years, some in 3 months. So maybe in the 4th month, now my cash flows come down to 79 million. Okay. And by the 60th month, my cash flows have come down to 60 million. Right. So as an investment bank, the investment banker should be able to model what is the expected cash flows from this portfolio over the loan period. And then looking at the set of cash flows over the loan period, they will keep a buffer. What is the buffer? We call that over-collateralization. Over-collateralization. Why do you over-collateralize it? You keep that buffer, usually it's about 30%, because in case some of these people start to default, I don't want the investors to be in trouble. So because of that, I have to leave a certain buffer. All these cash flows, I shouldn't be raising money through a loan using the value of all these cash flows. I'm only going to use 70% of these cash flows. I'm going to leave 30% as a buffer for default, for example. Okay. So I call that the over-collateralization buffer. So 30% less than 80, 30% less than 60, whatever, right? So let's just put some numbers in. Let's assume, so now this is 56 million or something like that. So 56 million is what I'm actually going to use. Although I'm getting cash flows of 80 million, or I expect to get cash flows of 80 million up to 60 million over the next 60 months, I'm going to ask investors to come and invest only up to these cash flows, only amounting to these cash flows. Then what do? I talk to my investors. I tell my investors, I have a securitization with me. I can offer to you. It's going to be backed by this pool of receivables. So the investment bank is now talking to their investors, right? Backed by this pool of receivables of 10,000 vehicle loans, high quality. It's been checked by the auditors, right? And I would like for you to come and invest. I'm offering you papers or debt instruments up to 60 months. So in Sri Lanka, generally how it happens, and this is not true for all over the world, but in Sri Lanka, typically how this happens is, for every month, a new debt instrument gets issued. So like a zero coupon bond, investors can invest for 1 month, investors can invest for 2 months, or 3 months, or 4 months, or 5 months, or 5 years. Like this, investors can choose what paper they want to invest in. So me personally, I would say, okay, I want to invest in the 12-month paper. You might say you're interested in investing in the 5-month paper. Somebody else might say they're interested in investing from 13 months to 24 months. What does this mean? When I say I'm interested in investing in the 12-month paper as an investor, I'm saying I'm willing to give money today to get back my money in 12 months' time. Right? And how am I giving money? I'm giving money as a loan, but it is a secured loan backed by the strength of this pool of receivables. So who's negotiating these terms? The investment bank. Who's negotiating these terms? The investment bank. Okay. They are talking to the investors, asking them to come and invest, offering them these different pieces of paper, secured pieces of paper, and I, for example, might say, if I'm investing in 12 months, I want this interest rate. Somebody else might say this interest rate, and the investment banker might say, this is too high for 5 months. I can give you this interest rate, right? So you do the negotiation. You say, you see whether it matches, the model fits with the cost of funds the company wants to raise money at, and you raise money on a secured loan. So who does this entire process? Help structure the financial instrument, coordinate with the lawyers, help find investors. Who does this entire process? The investment bank. Questions? Not having questions is not a good thing. Is it because you don't understand? What is the problem? Yes? No questions? Okay. So what are the cash flows that can be securitized? You have to understand you can do securitization for so many different things, right? I gave you one example of vehicle loans. Vehicle loans are 99.9% of the Sri Lankan securitization market probably. Most of our securitizations are based on vehicle loans. But HDFC, probably the early 2000s, they did a securitization backed by their housing loans. They raised money, they borrowed money from investors by pooling together and issuing a debt instrument that was backed by the strength of their cash flows of their housing loan portfolio. A lot of companies, a lot of finance companies do securitizations in Sri Lanka. So you can do securitizations for lease rentals, for hire purchase rentals, for housing loans, housing loan receivables, right? Like mortgage securitizations. You can do securitizations for building rent. You can securitize building rent. If a company, for example, wants to build a new apartment set or a new office tower, okay, and they want to raise money to build that new building, one way that they can do it is use one of their existing office towers where they're collecting office rentals. Securitize those office rentals to raise money from investors. This is an example of one thing you can do. All of these things are called contractual cash flows because you know by contract you are entitled to these cash flows over a number of years. You can have cash flows which are non-contractual, which can be securitized as well. For example, school fees. School fees are non-contractual because even though school fees are paid over the 12 years you are in school or 13 years you are in school for private schools, you don't know whether that child will be with you next year or whether they'll go to another school the next year. They are non-contractual cash flows, right? But you know with high probability that there is going to be a good set of people or children who are going to be in your school over the next number of years. These are non-contractual cash flows that can be securitized. You can securitize or you can secure, you can raise money via a loan securing your expected school fees. Richard Peary Supermarkets did a credit card receivable securitization, one of the only credit card receivable securitization as far as I know in Sri Lanka, or at least the first one for sure, where what did they do in their supermarkets? You know that it's non-contractual. You don't know how many people will swipe your credit cards. There can be this unusual situation where nobody swipes a credit card through any of their POS terminals. But it's highly unlikely, right? You know that certain number of people, when they come to their supermarkets, they're always going to be using credit cards. So what did they do? They borrowed money from investors by issuing a debt instrument backed by the strength of their credit card receivables. So they said all credit card transactions happening through these POS machines are going to be pledged to this trust, and I'm going to raise money because I'm going to pledge to the trust over the next 5 years or next 3 years all transactions of these 5 supermarkets happening through these POS machines. Right? That was secured. All that money went to the trust bank account. The investors knew that no matter what happened, all the money that is secured through a certain set of machines or supermarkets belong to them. It has been pledged to them. And backed by that strength, they gave money to this company. You can do securitizations on utility payments. CEB can borrow money, for example, by securing their future receivables from their customers. You know that everybody is going to be using electricity. So if they can identify a set of customers, cordon them off, pledge any receivables from them over the next number of years to the trust, then the investors can give money based on the fact that you know that there's a number of customers' money that has been pledged to you exclusively. Roads can be built based on securitizations, right? For example, to build the next road, you can use the toll collections of the, let's say, for example, the Southern Highway. So it might not be enough in this case, but where you have roads with high traffic, where you can justify the amount of toll collections, you can use part of that to raise money for the next highway. And how are you raising money? You're not borrowing from a bank, you're not borrowing from the government, you're not borrowing from another sovereign nation. You're essentially you're borrowing from investors, you're asking investors to invest to build the next highway of the country. These are different things that you can do, different ways that you can raise loans. You can do securitizations on so many things. There are, for example, exotic securitization deals that have been done. David Bowie, I don't know if you all have heard of David Bowie, a famous singer who died recently, very famous in 1970s, I think. He did the first securitization. He secured his royalty payments. So of his music albums, because he was a very famous singer during his time, his albums, you know, were going to generate royalty over a period of time, right? So what did he do? He said, okay, these albums, I'm going to pledge it to this trust for the next whatever number of years, and all royalty generated over that number of years belongs to the trust, and investors will get paid back from the royalty that I generate from these albums. Bonds, James Bond movies. How did they, one way that they secured money for the next James Bond movie, or raised money for the next James Bond movie to produce the next James Bond movie, was securitizing the royalties they were going to get from the past James Bond movies, the proceeds from the past James Bond movies. So they took James Bond movies are a franchise, right? You have so many different movies. So they said, we'll take these movies, and any revenues generated from these movies over the next number of years is going to be secured into the trust. All the revenues will belong to the trust and will be used towards paying the investors back. And backed by the strength of those receivables, they raised money to do the next James Bond movie. There are so many different ways of doing securitizations. There are so many different ideas that you can have to do securitizations. Any questions?
Yeah, madam, where's this trust accounts maintained in investment bank? Or?
No, so good question. Trust accounts are essentially held by an independent third party. So it won't be the investment bank. Generally, trust services are done in Sri Lanka. Most trust services are done by Deutsche Bank, HNB. Ceylon did a little bit for a while, but mostly Deutsche and HNB, they are the two main providers of trust services. So very few banks would do trust services, and any bank that does trust services can act as trustee. So from that question though, can I ask you all, does that mean in case the company defaults that the trustee is liable to pay? So technically, first and foremost, you're actually not depending on the company to pay you back. Remember, you're depending on this pool of receivables to pay you back. Or depending on the strength of the quality of the portfolio that has been pledged to you to pay you back. The trustee anyway will never take on the responsibility of paying back the investors. He's only there to ensure that the company sends the money to this pool, and all processes that have been done to be done for the securitization have been done in the best, have been done in a way that safeguards the interest of the investors. And that in case the originator company defaults, he will, or any of these people who are giving money to the trust, the leasers, they default, trustee might have parata rights to go and execute and make sure that the money comes to the trust. The trustee will never take on the responsibility of paying back the investors. They are simply an independent third party who are there to oversee the portfolio that has been pledged to the trust. Other questions? Question? Okay. That's about securitizations. So now, if you remember, we've done equity and debenture IPOs, commercial paper raising. So this is all about helping clients raise money. Securitized paper, and finally syndicated loans, right? So in terms of helping clients raise money, the other activity that I wanted to talk about was syndicated loans. What do you mean by syndicated loans? What do you mean by syndicated loans?
Involving it many banks.
That's right, yes. A syndicate is actually a group, right? So a syndicated loan is essentially a loan given to one borrower by many banks, many lenders. So many lenders get together into one syndicate or group and use that, get together into one syndicate or group and then give money to one borrower. I mean, obviously, you're not going to get into a syndicate as bankers to give money to me, right? When would a syndicated loan become important? Me, in a sense, me as the individual, you're not going to get together to give a loan to me as bankers, right? You're not going to form a syndicate to give a loan to me. But when would a syndicate become important?
For the projects.
For project financing, yes. For big projects where one bank may find it a little too intimidating to take on the risk of that project, where the riskiness of the project is so big, for example, that if the project fails, the bank might be in big trouble itself. But if you have several banks participating together, then risk is diversified. So for big infrastructure projects, loan syndications become important because you have a group of lenders coming together, so a group of banks coming together where the project requires, the loan required is too large. So there might be, for example, one company wants to borrow for a big project, but there is single counterparty exposure because the project is too big. Limits are reached. It might be that the loan is too big for the bank to take on the risk by itself. So when you come together as a group, it allows you to spread the risk. It allows you to reduce single counterparty exposure. So all of these problems become mitigated. Okay. How does an investment bank help in loan syndications? How do you think an investment bank can help in loan syndications?
Coordination.
Yes, it's definitely major part is coordination. So it's one is negotiation on behalf of the borrower. Investment bank can be the party who's talking on behalf of the borrower, trying to sync the terms and conditions together. Two is the fact that when you have many banks participating, every single bank will want the best terms and conditions for themselves. Right. But you obviously every single bank cannot get the best terms and conditions. And usually you would want in a syndicate for everybody to have similar, not all the time, but most of the time similar or same conditions so that everybody is in the same footing. Right. So if one bank can say, no, I will not come if this condition is not met. It's up to it would be the investment bank that would coordinate among the banks, that would negotiate between the banks as well as the banks and the borrower for all the terms and conditions and the legal documentation, and if any due diligence needs to be done with the auditors in all of these terms and conditions and structuring of the loan if that's required. All of these would be done by the investment bank. Right. So that's how investment banks help raise money for people. Investment banks also provide other advisory services, right? Like, for example, M&A advisory. Advisory for mergers and acquisitions, advisory to spin off divisions, advisory to sell off divisions, right? You would have seen sometimes in the papers big advertisements by investment banks. Next time you see an ad, look at it, where it says, this investment bank congratulates this client on its spin-off. It's an advertisement for the investment bank to say we are the people who help the client do that. So in a merger or acquisition, you would always have two investment banks representing the two parties. You will never have the same investment bank representing both parties because it is a conflict of interest. So say, for example, you have two parties who are looking at merging or acquiring the other person, and merging with the other party or acquiring the other party. A would be represented by investment bank X. B would be represented by investment bank Y. If investment bank X tried to represent both A and B, there would be a conflict of interest because investment bank would ultimately try to work for whoever is giving him the highest fees. But if A is represented by X and B is represented by Y, these two investment banks would negotiate with each other for the best terms of their clients. So never in an M&A transaction should you see the investment bank representing both sides of the transaction. So what are the types of things the investment bank would do in an M&A transaction? So A is trying to buy over B, or A and B are trying to merge together. What are the things that would need to be undertaken in these types of transactions? Where can the investment bank help? What do you think? Well, for one thing, A comes and says, I want to take over B, right? And makes an offer. How does B know that this offer is correct or not? A comes and says, I want to take over B. And A says, I will buy all shares of B at a price of 80 rupees each. For one thing, how does B know this 80 rupees is fair? For another thing, how does A know I should offer B 80 rupees? Investment bank X would probably help A do the valuation on B, right? because they would be the ones who would work with A to figure out what are their plans for B, what do they hope to do, how do they hope to amalgamate together, and therefore with that amalgamation, what are the synergies they hope to achieve. Based on those synergies, what should be the value of this company? And what should be the best of a price? Because if you offer more than that, this deal is not worth it. So that's one thing the investment bank will do. They will help in the valuation process. Same for B. How do you know whether A's price is fair or not? Whether A is lowballing you or whether you can do better or not? That's where investment bank Y comes in, where they will work together with B, look at what are B's internal processes, where does B do best, why might A be trying to acquire B, and what might be A's agenda by acquiring B, and what are the benefits they might gain, and therefore what is the price that B should accept. Because especially if it's a hostile takeover, A and B will never come into an agreement. Versus if you have an independent third party looking after your interests, it's easier to come into an agreement. So one thing, investment banks will do the valuations. They will look at the deal specifics, what is happening with the deal. So if you start from like the bottom, okay, where you might start at a place where you don't have, where a company says, a company might simply go to an investment bank and say, I'm company A, I have these strengths, and I want to find a party to merge with or acquire that will give me these strengths. So for example, I'm company A that is right now engaging in, let's say, I am a fabric manufacturer. But I am in fabrics. I am at the lower end of the spectrum. I want to get into, let's say, knitting, meaning not just fabrics. Now, I don't want to just do textiles. I want to make shirts and value-added garments, right? But I don't have the expertise, so I want to acquire another company. Can you help me find a company that is efficient, that is maybe undervalued, that I can buy over, that will give me those synergies? So it could be as simple as that, or it could be that A has already identified B and comes to the investment bank. Or A can simply come to the investment bank and say, I have these requirements, I want to buy a company like this. Do you know anybody, or can you suggest anybody? So investment bank will look at, what is the criteria, they'll search for the target, and they'll do the planning process. They'll value the acquisition, do the negotiation. And not just the negotiation, it's very important to the due diligence. Remember the due diligence process? Remember, you have to make sure when you're buying B that there is nothing hidden inside B that might be disadvantageous to A. So it's very important for investment bank X to coordinate that due diligence to ensure that that due diligence is done thoroughly, and A knows everything about B before buying it. So coordinating the due diligence, and then negotiating the terms and conditions, drawing up the sales and purchase contract, and also finding financing. It's easy enough to say I'll buy all your shares at 80 rupees, but to buy all these shares at 80 rupees, if it costs 8 billion, how is A going to do that? So the investment bank will come in where they will try to find financing for the project as well. So these are different things where investment bank can help you with. Obviously, they will also help you with legal issues, in the sense they will coordinate with the lawyers, they will coordinate with the auditors, they will coordinate between the parties, look at the valuation, try to identify the parties. These are all different things an investment bank will do in an M&A type of advisory service. And it's advisory. Understand, it's advisory. All of these are investment bank advising the company what to do. Ultimately, it's a company who will do what they want to do. investment bank will simply facilitate the process, and for doing that, they will charge a fee. Any questions? So, we've talked about mergers, acquisitions, spin-offs. So do you see, like commercial paper, to help facilitate that commercial paper transaction, investment bankers charge a fee. Securitized paper to help structure the transaction, facilitate that transaction, investment bankers charge a fee. Syndicated loans to coordinate that transaction, investment bankers charge a fee. Equity and debenture IPOs, again, what do investment bankers do? They help coordinate the transaction, facilitate the process up to listing, help place it with different investors, market the issue, and for all of this, investment bank will charge a fee. In addition, investment bankers can do, simple business valuations where a company just wants to say, doesn't want all that other negotiation part, but says, I have a party I want to sell this to. They're offering me this much. Is this fair enough? So they'll do simple business valuations, right? They'll do business restructuring or balance sheet restructuring advisory. That is where they look at your balance sheet, analyze the balance sheet, company's balance sheet, where, say, for example, companies that are highly leveraged with high debt equity ratios, they'll analyze the balance sheet and they'll suggest ways of reducing debt. Maybe converting debt to equity, maybe reducing debt, maybe changing the type of debt from rupees to dollars or dollars to rupees if possible, right? So they will analyze the balance sheet and provide different solutions to restructure it in a way that it optimizes your capital. And there are instances where companies will hire you to do market research. As an investment banker, you will be hired to do market research, where again the company says, I am in this industry, like I was saying before, let's say textiles. I want to know whether I should forward integrate or backward integrate by a company in value added, or should I stay as I am? What is the best thing to do? Or I'm planning on entering Sri Lanka. I'm a company coming from abroad. I'm planning on entering Sri Lanka with these products. What do you think my demand is going to be? These types of market research also investment banks can do. Depending on their expertise, they will take on the project. But you can see most of these are fee-based services that investment banks are doing, other than if they engage in any underwriting services. Those would be fund-based because you would need to have your own funds. Remember what we said was underwriting? If the IPO, for example, debt or equity, if the IPO was undersubscribed, then the investment bank would buy what is undersubscribed, right? So my example was 800 million IPO, only 200 million was taken up by the shareholders, by investors. So the investment bank underwrote 600 million in that example that we did before the break, right? So investment bank, if it was investment bank and not an independent bank that is underwriting, then the investment bank would have to have money of its own. It would need to be fund-based. And in Sri Lanka, we don't have a lot of fund-based investment banks. Very few. Commercial bank is one, because they are a division of commercial bank itself, right? So with that, as well as NBSL sometimes does underwriting as an investment bank. Again, so NBSL, you have the commercial banking aspects, and you have the investment banks or capital markets division. Questions? Okay. So when you are now, some of you may have heard of investment banks before. So for some of you, it might be the first time you're hearing about investment banks. What do you think? Are investment banks in conflict with banking activities? Or can you all work together? Are there opportunities? What do you think? It's your opinion. What do you think?
Investment banks give us opportunities. The
Like
investors
what?
give so to find out the better and the suitable investment opportunities.
For different companies, yes. So investment meaning not places to invest in, but different ways to invest in. Yeah, definitely. It gives you opportunity. I also believe if you're working in if you have an investment bank in your bank, inside your bank, there are a lot of opportunities that can arise. So because investment banks will see a different type of investor. And also now sometimes you will have clients who come to you as a banker. You might not be able to facilitate the client's every need. The client might want a loan from you, but right now, maybe because of single party exposure limits, for example, or maybe because of other reasons, something else, you can't give a loan to the client. Instead of turning the client away, you can work with your investment bank, because it's internal, right? Although the investment bank will find external parties to come and lend money to the client in terms of debentures or commercial paper or some other way, you're still keeping the client in-house, right? So with this, even if you as a bank can't offer a traditional banking solution to the client, maybe the project is too risky for you to undertake. If you have an investment bank, they can structure it in a way for you that you spread the risk either through a syndication if the project is too big, or maybe you structure it in a securitization where you can pledge the cash flows to an independent trust and do a type of securitization type of loan. So these are different ways that you can work together with investment banks. So where you have different clients coming into the bank, companies or governments who want to raise money, and you immediately can't give a solution, but there might be other solutions out there that you can work together with the investment bank to figure out whether the best option is to give money internally, lend money from the bank, or whether to help the client raise money from the capital markets. So even if it's not, then the bank is not giving a loan directly to the client, maybe the bank can participate in part of the loan that is being given coming through the capital markets, right? Or you're still keeping the client happy because you're offering a wider solution. Because you're keeping the client in-house, you're sending the client from your department to your investment bank, for example, where the client is still, you're still working within the same group umbrella, but you're now offering them more solutions. So definitely there are opportunities that can arise by working together with the investment bank, because there are different ways. There are different instruments that the investment bank may have seen offered. There are different investors, and sometimes it might be even as simple as the fact that clients don't know. Just like some of you all wouldn't have known who are investment banks, clients also wouldn't know who are investment banks. They might be coming to you. You might be the branch manager of a certain bank branch wherever, right? And they might be coming to you and saying, "I'm planning on selling my business. I'm not sure. Do you know anybody who would like to buy it?" You can work together with the investment bank to help the client sell the business, right? So that's not part of your mandate, but you're doing something additional for the client, right? So, and you're actually, internally you're generating fees as well. So that's fee revenue as well. So obviously, when you're in your branches, your clients will have different requests, right? It just won't be for a loan. It will be for different things that they will have requests. And when there are requests in that nature, you can always work together, especially in project financing. Again, structuring the cash flows in a way that the bank is comfortable to take that risk. All of these things are things that investment banks can help with. Okay, so what? Anybody else? No questions? So we've come to the end of this part, right? So I've talked about investment banking activities. So essentially, I told you, so what we did was essentially pure play investment banks. That's what we looked at today. I told you investment banks can be pure play investment banks and full service investment banks. Full service investment banks include, other than pure play, where we look at M&A, sales, underwriting, and so on. Full service investment banks will also look at asset management, even commercial and retail banking might be there. So next time we meet, we're going to concentrate on this area, on asset management. So looking at different ways that you can manage funds other than traditional banking deposits. Okay, so we can stop at that if there are no questions.